Hey guys, and welcome back to the Young Investors Podcast. We're back again with episode 57 today, and joining me as always is Brandon. What's going on?
Not a lot. How you been?
How's your week been? Yeah, pretty good. Not too bad.
Yeah.
Made an interesting video this week, something a little bit different.
Yeah, I saw that.
I think we'll probably talk about it.
Yeah, it's funny because when I was watching that, I was thinking the exact same thing. All the things you were saying, I'm like, geez, that's so true. Because it's so annoying how much that ad's popping up at the moment. But yeah. Yeah.
No, we'll definitely talk about it. But as always, we'll go through the indices. We'll go through some news. We've got a ton of news stories. So big chunk of this podcast today is going to be focused on some of those news stories.
Yeah.
And then we're just going to do, in the middle section today, we're going to be doing a listeners Q&A special once again. So we've compiled a bunch of your questions from past podcasts and past videos and that sort of thing. And we're just going to basically go through and discuss a bunch of topic points from you guys. So, as always, guys, if you have any questions for next week's podcast for the Q&A section, then make sure you go ahead and head over to the YouTube version of the podcast, which will be at youtube.com/Hamish Hodder. Head over there and find the video version of the podcast and leave us a question or a topic there.
Yeah. I really need to change my YouTube URL because I'm pretty sure I haven't changed mine yet. Mine will still be like $XY87. Imagine that.
Yeah, you gotta.
I really need to get on that. It's just like, all right, and for this week, go over to youtube.com/user/XYM25. No. Anyway.
Gotta make it easy for people.
Sorry, what were you gonna say?
You've got to make it easy for people.
Yeah, I know. I've just been lazy. All of those little housekeeping tasks on YouTube have just gone out the window. It's like I got to fix up so much stuff in my descriptions, but it's just like, oh, that can wait. I've got too much stuff to do. Yeah. The life of a YouTuber. No, it should be good. Yeah. I'm excited. We got a lot of questions today. This will be a good podcast.
We do.
Yeah, we certainly don't have a shortage of things to talk about. With that said, should we get started with the indices?
Yeah, so I'll just run us through. We've got the Dow, which was down 0.4%, the Nasdaq down 0.1%, the S&P 500 down 0.2%, and over in Australia we have the ASX 200 down 1.3%, and of course the All Ordinaries also down 1.3%.
Wow, particularly uninteresting today.
Yeah, particularly because all the other times have been so interesting.
just absolutely. I tell you what, I listened back to this podcast just to hear the indices. That's got to be up there in my top 3 reasons to listen to this podcast.
And that's it for this week, guys. That was the Indices Young Investors Podcast.
The Indices special. We just spend an hour going through every single index from around the world. And then it's like the ASX 20 was up by 0.1%, the ASX 50 was up by 0.1%, the ASX 100 was the ASX 300, the ASX 500. Oh, dear.
Brilliant idea.
Yeah.
Leave a like if you want us to do that.
That's not the right way to go. We're not going to get any likes on this video now.
Yeah. Anyway, we should get into some news. Should we go through this news? This first news story.
Yeah. This first news story is interesting. I just spotted that the Uber CEO has just bought 250,000 more shares. I don't know. Do you know how to pronounce this guy's name? I have absolutely no idea how to pronounce it. Mr.
No. I was watching a couple of CNBC clips before, and no one got it right.
No one got it right.
Everyone was pronouncing it different, and everyone was just stuttering and struggling. But
Mr.
you can have a crack if you want.
Khosrowshahi. That's what I'm gonna say. Khosrowshahi, just say it with confidence. Mr. Khosrowshahi paid $6.7 million on November 18 for 250,000 Uber shares. That's a lot. Yeah. Average share price here of $26.75. So he now owns 1.53 million Uber shares. There you go. That's pretty nuts.
Right.
Imagine having that many Uber shares. That'd be nice. Although I don't think I'd hold them, to be honest. I think I'd sell them if it was me. It's a very interesting sign. Obviously, we always look at insider transactions when it comes to our different companies, because they can be quite telling. They can give you little hints, especially if it's coming from the CEO. Because at the moment, Uber is down 35% from its IPO price of $45. So it's currently sitting at around about $30 per share. And what's even more interesting, to add a little bit more spice to the tale, is that the founder, or the ex-CEO, he's been selling recently. He's sold up to $1.3 billion worth of stock. Right. So he's really getting out. I didn't actually know this. He was actually ousted as the CEO. He got kicked out.
Yeah.
I would have thought he maybe just stepped down, but no, he actually got kicked out. But yeah, so it's been interesting because he's been selling quite a bit, $1.3 billion worth of shares, which leaves him only with 2.6% ownership in the company. He's only got 45 million shares.
Yeah. Which is still worth about $1.3 billion because I mean the company's valued at $50 billion.
Yeah,
which is that's another topic for another day. I
guess. I tell you what, it probably wouldn't be. It would be quite an interesting company to look into, because one of those ones where they're not running profitably, but at the same time there's such a potential future market there that that there are, like, it's same kind of with Tesla. There's positives and negatives to the story.
Yeah. It's I mean, it's interesting. I really like the business, but whether it is a business that can be really profitable is just something we haven't seen it yet.
Yeah.
There's no ride sharing business that has operated profitably, as far as I'm aware.
Yeah, actually, I don't know of any of them either, to be honest, which seems bizarre.
Yeah. Yeah, I mean, I'm not sure if I'm getting this right, but I think that Uber's core business, just their normal ride-sharing business, actually is profitable, but it's actually the Uber Eats component that is driving that down.
Okay. Because it doesn't make sense how that system could not run profitably, because Uber takes their cuts straight away. Like, they take the same percentage cut before the drivers get anything. So you would have imagined that. I mean, they just have to maintain their app, and the drivers get a percentage and Uber gets a percentage. I would have thought they'd figure it out. That seems like it should be a profitable business model, but I don't know. Yeah, to be honest, I don't know enough about it to understand why it's so not, but maybe it is just something like an Uber Eats, which doesn't work out with the economics.
Yeah, exactly. It'll just be something we'll have to see. I mean, we always look for insider buying and insider selling as an indication. This is a particularly interesting case because the CEO is buying, but the founder is selling.
Yeah,
selling quite a lot.
Yeah, it seems to me as though this founder is just done. Like, just I'm out.
Yeah. Yeah, it's certainly going to be interesting. I'd love to see, I should have looked this up before, but I'd love to see what the current CEO's sort of compensation is, because what does he hold? He holds about $46 million worth of stock as the current CEO.
Okay.
Which is, I mean, it's a lot, but I could imagine that a $50 billion company has a CEO that's getting paid quite well.
Yeah, probably.
It'd be interesting to see what the relationship between those two were. Is he putting a lot of his wealth into Uber, or is he kind of, is 45 million kind of just a little bit of a drop in the bucket?
Yeah, no, it's a good question. But yeah, an interesting case with the CEO buying, but the founder selling. So, watch this space, I guess. But to be honest, Uber, like, I don't think you'd ever look at Uber. I wouldn't look at Uber just because it's such a new company. It doesn't have a proven track record. It only IPO'd this year. So for us, I don't think, well, I can't speak for you, but I'm not particularly interested in the business, in a potential investment, especially the fact that it doesn't run profitably. But still interesting for all those Uber shareholders out there.
Definitely. And now it's time for the Tesla component of our podcast.
All right. Tesla time with Brandon and Hamish. Well, welcome back, everyone. Welcome back to Tesla Time with your hosts, Brandon and Hamish. Now, today on Tesla Time, we have some very interesting news. Is that last night the Tesla pickup truck was unveiled in California, and the event was an absolute shambles. Oh my gosh, that event. Oh, I was cringing so hard.
It wasn't clean, was it? It was not good.
It was horror. It's probably the worst event that I've ever seen from TED. Like, I know that Elon is not a good public speaker. Like, you can hear that in his voice. He's the flippin' stutterer of the century. But this event was shockingly bad. So it all starts, right? So first of all, the pickup truck itself. So there's this massive hype up around this pickup truck, and then they bring it out. And we always knew, like, Elon's been saying for a long time that this thing's gonna look out there. And boy, it really does look out there. So if you haven't seen it yet, I'll definitely encourage you guys just to flick a Google tab open and have a look at some of the pictures, because it's very odd aesthetic. It's very futuristic, but at the same time, it looks like it's out of an 80s sci-fi movie.
Yeah.
It like looks modern day futuristic, but also old sci-fi kind of style. I think it kind of looks like a big DeLorean.
Yeah.
But it also kind of reminds me of something that you could see like in a Mars TV show render or something like that. Like, that's what they'd be driving around in. It looks bonkers.
Yeah, when it came out, the first thought I had was just Back to the Future. It just kind of gave that vibe of the kinds of things that you saw in Back to the Future in that 1985 movie, and what they kind of thought of. I still find that very funny that they had in Back to the Future 2, I think it was, their future time was like 2015, and it had like flying cars and stuff. But I think, I don't know, MKBHD kind of said that you'll either love it or you'll hate it. I can't say that I love it.
No, it's it's weird. I'm kind of stuck liking it and not liking it at the same time.
Yeah.
Like, it's interesting. Like, it's a bold design choice. I mean, it's really out there, but at the same time, there's just something about it that having it's the harsh angles of the roof section that really gets me. I don't know, but Anyway, it looks crazy. You should go and look at it. But the real cringe. The real cringe is in the event itself. So they basically bring this thing out onto the stage. Elon starts talking about how amazingly strong this truck is. It's got this ultra hard 30 times cold rolled stainless steel exoskeleton. Everyone's like, ooh, fancy words. Anyway, Franz comes in, the designer, and he kills the crap out of it with this sledgehammer, bangs it right into the side of the door, and the door just does not flinch. It doesn't dent, it doesn't do anything. It just stays super strong. So then the crowd's kind of warming up. They're like, oh yeah, this is something special. And then they start hyping up this super strong glass. They bring out this big sheet, right? And they start throwing a couple of these metal balls at it. And the sheet glass holds up to all the tests just fine. And then Elon says to Franz, he's like, oi, throw that ball at the window. And so Franz picks up this ball, chucks it straight at the window, and the window just like shatters. It was horrible to watch. It was just like, oh, it hits you deep down inside. It was so cringe just watching that. Elon like swears on the mic, and then it's just oh my God. It's just this horrible situation. And then Franz turns to Elon and is like, oh, why don't we try the back window? Oh my gosh.
Terrible idea.
What are you thinking?
Oh,
so they throw it at the back window, and then the back window smashes as well. Oh, cut your losses far out.
Yeah, that was hard to watch. That was tough to watch. Poor Elon. He looked so devastated.
He was. It totally changed his vibe. I've been watching a couple of reaction videos from people that were there, and they were saying that once the window shattered, it really changed Elon's vibe. Like, he was so pumped about it before, and then it almost seemed as though after that he was just trying to rush. He was just rushing to get the presentation done. Yeah. And it's kind of seemed that way because the presentation was over in a flash. There were still so many specs that he didn't talk about. He didn't say like when the truck was coming. He didn't say all these different things. It just seemed like the second half of the presentation was just rushed and awkward. Like, when he was talking, the presentation slides in the background weren't matching up to what he was talking about. and then that was throwing him off. He started talking about one subject, then the slide would change, and then it was like, and he would start talking about something different. Oh, my God.
Yeah, not good.
It was bad. It was bad. It was real bad.
Yeah, I mean,
yeah.
I mean, stuff like this happens with demos, and usually, I presume there'll be some kind of statement that Tesla comes out with, saying like, "Oh, we didn't have the right glass in the car or whatever." Because I remember, obviously this is not the same as this, but Apple's event, they were trying out the Face ID and it didn't work, and everyone was like, he couldn't even get it to work on stage. And then Apple came back out and said, well, it was actually because his face wasn't registered in it or something. It was like someone switched it out, or they'd done they'd used the wrong phone or something.
Okay.
Yeah, man, it was not good watching that. And then Elon having to stand up there and continue presenting with a car behind him that had smashed
windows. Oh my God, that was terrible. It was like good 20 more minutes of just him talking with this smashed up car behind him. It was like, I don't know. If you're someone that that likes cringy moments, if you're someone that loves to watch cringe compilations on YouTube, then watch that presentation. But yeah, it's interesting though. They had a one more thing, as they sometimes do with these Tesla presentations. Their one more thing was they announced this ATV, this quad bike. But again, like they brought it out. They said, "Oh, by the way, we built an ATV," and they showed it, going up into the back of the ute and then shutting up the body. But that was it. They didn't say anything else about it. And then it just sat in the back of the truck. It's like, all right, cool.
Yeah. It was
so we got no idea, like no specs on that, no estimated delivery dates or anything. It's just, oh, by the way, here it is. Bye.
Yeah. It's like, to me, it felt the vibe that I got, and I don't know if this is accurate, but the feeling that I got watching it was that they were just not prepared for that presentation in the way that they've been in the past, and they still wanted to impress people and, have a really big show. Like they had, the start of the presentation with lots of the lights, and it was a huge kind of spectacle, and I feel like they just weren't prepared for it or something. I'm not sure. Like, were they planning on throwing a ball at the window, or was that something Elon or the other guy just kind of spur of the moment said, and they kind of just went with it? Maybe that wasn't part of the plan. Who knows?
Yeah, I don't know. Anyway, that's what happened with Tesla this week.
Yeah.
We're hoping to get Gally on the podcast next week, so we'll talk to him about it more, because he was actually there. It'll be good to get his insights from someone that was actually at the event.
Definitely.
But with that said, should we move on to our next story?
Yes, the next news story that I had here is in relation to Ray Dalio, big investor that many people would be aware of. His company, Bridgewater Associates, is the largest hedge fund in the world, if you're not aware. And essentially, a report came out of the Wall Street Journal this week that they had made a $1.5 billion bet that the global stock markets would decline steeply before March 2020.
Wow. Okay, I didn't see this.
Yeah, so this came out and everyone kind of lost their minds, and Ray Dalio was quickly onto Twitter to say that this is not him and his company believing that there's a sort of bearish outlook on the world economy over the next year. It's simply a hedge bet, and even though 1.5 billion sounds like a lot, it is a lot. It's actually less than 1% of their total assets under management. So
imagine that.
Yeah, in the big scheme of things, it's a very small bet, but it kind of caught headlines and everyone kind of freaked out for a little bit. And yeah,
man, imagine dropping 1.5 billion on an investment or a bet, and it only being, what was it, less than 1% of your net worth.
Yeah, they have about $150 billion worth of assets under management, which is insane. Crazy. How do you even make a high return with that? That is insane.
Oh, yeah. Good question. I don't think that's the thing, is that once you get to a certain size, you really get hampered. Yeah. That's why we can do so well as individual investors, but the big fund managers generally can't outperform the market. They just can't get these big returns. They're so hampered by their size. But yeah, still. Oh, that's interesting that he came out and he explained why they were making that bet. Because if he didn't say that, then everyone would have been well, a lot of people listen to Ray Dalio. I probably would have listened. I would have been like, oh, shit, is the market going down before March? Try and look into it a bit more. But there you go. It's a bit of a non-issue in the end, just a hedge.
Yeah, exactly. It's a bit of a non-story, but I thought it was interesting because...
no, it is interesting for sure.
Yeah.
It's a big amount of money to be chucking down. But, well, for anyone apart from select few like Ray Dalio.
Yeah, no, it's he's managing a lot of, well, I mean, he's not managing it anymore, but his company that he founded is managing a lot of money.
So what does he do? Does how is he a part of it now?
Yeah, so he stepped down. I don't know the exact date. It was in the last few years he stepped down from running the company. And he really just does sort of charity work now. He writes books and he just sort of helps people understand the markets a little bit better. Yeah, so he's
okay.
He's not.
So he doesn't really have too much of an active role anymore.
No, I think he's completely out of that business.
Oh, okay.
But because he founded it, and it is the world's largest hedge fund, he still gets very much associated with it.
Yeah. Yeah. Oh, I love Ray Dalio. Man, he's so good. He's just a wealth of knowledge on the stock markets.
Yeah,
go and watch some. You watch some YouTube videos with him in there, and you know you're in for a good time. You learn a lot.
Yeah, so, all right, the next news story we had here was out of Westpac, so back home in Australia. There was some money laundering and child exploitation. Oh, no.
Yeah.
What's going on there?
Well, I don't believe that Westpac was actually partaking in money laundering and child exploitation. However, the news story, they are associated with it, though. The news story reads that Australia's financial crime watchdog lodged a statement of claim in the federal court alleging 23 million breaches of money laundering laws. The claims include that the bank knew since 2013 of child exploitation risks associated with some payments to Southeast Asia, but did not act appropriately until 2018. And still does not monitor all channels for transfers potentially linked to the live streaming of child abuse. So, yeah, good one, Westpac. Maybe should have acted on this a little bit sooner, but basically now the Westpac's been found out. The board and the CEO, they've all come out and said, we are just so sorry. We feel so bad about this. Look, I know that we've had 5 years to do something about this, and I know that we haven't, but we are so sorry, and this impacts us deeply.
That's
It's like, come on, Westpac.
This is 2013. It's a long time.
It's a long time.
It's a long time to sit on that.
I'm pretty sure it's not that hard. If you're a bank, I'm pretty sure it's not that hard for you to monitor payments.
Yeah.
I'm pretty sure that would be one of the more, simple tasks that a bank might be able to do is monitor the payments that go through it.
Yeah.
Oh, God. To be honest, I don't know a whole lot about this story, but geez, it's an attention-grabbing story when you see that headline. Westpac's money laundering and child exploitation scandal. It's just like, seriously. I mean, fair enough if these companies can see these weaknesses and choose to do nothing about them, and then it comes back to bite them in the butt. Like, fair enough, I reckon. It's like, do more. Like, that's the same thing. It's just like one of the most common problems that we see or run-ins with the law that we see from companies is that they end up underpaying their employees. It's just like, if you know that you're underpaying it's not hard to know that you're underpaying your employees. It's really not hard.
Yeah. I mean,
it's like if you get found out for underpaying your employees, fair enough that you get in a lot of trouble for that. Like,
yeah,
I don't know.
I mean, I guess it's kind of one thing to not be aware of something because they're not doing enough, they're not spending enough money monitoring or something and not being aware of it. That's one thing, but then it's another thing to know about it and to not do anything about it.
Yeah, and not do anything about it.
That's the bit that's getting me. That's really strange. But I guess, yeah.
It seems like it's very early on in the story, so I guess we'll see how this one plays out. But it doesn't look great, does it?
No. Yeah. I mean, the banking sector in Australia has just been hammered since about 2015. I mean, Westpac in particular, since 2015, is down 38% from its all-time high. So they really haven't been doing well at all since we had that Banking Royal Commission, and then a bunch of other things have been happening with the banks. And
I don't know. To me, banks just seem dodgy. Maybe that's just my view that's been developed by just reading too many news stories. They all just seem dodgy to me.
Yeah, they end up doing a lot of dodgy stuff because they know that at the end of the day they're a necessary unit in the economy.
They can get away with stuff.
I mean, you can't. If NAB goes away tomorrow, like, what, 1 in 4, 1 in 3 people lose their money? Like, if that was to happen, like, that's how important they are to the economy. Like, most people's money is invested, or not invested, but stored in one of these 4 major banks, which gives them a lot of power to just
the government
do reckless stuff.
Just give them a pass on anything, really.
Yeah, pretty much.
Anyway, I don't like banks. To be honest, I don't think I'll ever be an investor in banks.
Yeah.
That's just me, though. And I don't know, they're just outside my circle of competence, too. I don't particularly enjoy reading about banks. I find that stuff quite boring, to be honest.
Yeah, I don't either. Their annual reports are always a ridiculous amount of pages longer than any other annual report, and it's just not that interesting.
Hey, what should we talk about next? Should we get into... We got some more news stories, but should we... I don't know, we're about 26 minutes or so into the podcast. Do you want to get into some Q&A, or...?
Yeah, let's do some Q&A. Let's do it.
Yeah? Alright, let's go. Because I think the most value from this podcast will come from the Q&A, and we do have quite a few Q&A questions to get through today. So, should we launch with the first one? Should I ask this to you?
Yeah, for sure.
Alright, so the first question here from the listeners is, how often do you value or analyze stocks you have invested in? Is it like a constant process, or do you just come back every quarter?
Yeah, that's an interesting question. I mean, I guess in terms of... So there'll be one point at which you do a thorough analysis and you're going through all of the components. And that'll be something you do at one sort of point in time. Maybe you do it over a period of a couple of weeks or something like that. And then for me, just sort of over time, I'll continue to learn about the business and keep up to date with news. So in that way, I'm still kind of in the analysis mode. When there's some kind of news story that comes out, I think about how this affects the major components of the process. Does this affect how much debt they have? Does this put that too high? Does this affect my ability to trust management, that sort of thing? But in terms of doing like a complete analysis and going in depth over the company again, that's not something I do very often. Maybe once a year when the annual report comes out, and see what's fresh with the business, what changes have happened over the year. But on a quarter-to-quarter basis, nothing sort of major happens that I need to go back and... For most cases, there's nothing major that happens where I need to go back and do a full analysis. What do you think?
Yeah, I'd agree. There's definitely, obviously, before you invest, there's that big period where you're trying to learn as much as you can. For me, I don't know, maybe it's through inexperience, but for me, that process probably takes like a month at least for me. But if I'm invested, then just personally, like, this is just my approach, is that I'm pretty much in constant analysis mode. But that's basically because the stocks that I'm invested in, I like them. So naturally, I just pay attention to them. So I definitely pay very close attention and keep kind of analyzing around the quarterly earnings time, and when I get to listen to the conference calls and that sort of stuff. I try and spend more time around the quarterly reports to just make sure everything's on track. But once I'm actually invested in a company, I really do try and just keep up to speed with it on a week-to-week basis. But as I was saying before, because I like the stocks that I'm invested in, it's not like a chore for me.
Exactly. I mean, that's it really at the end of the day, is you need to pick businesses. If you're going to do individual stock analysis, then pick businesses you're interested in, because you need to... You have no chance if you're not going to be learning and keeping up to date with what's happening on a day-to-day basis or on a week-to-week or month-to-month basis with that business. You need to be keeping up with that information. And I mean, if it's a business you love, then it's not a chore at all to put on the quarterly conference call and listen to that and keep up to date with the news. It's actually really exciting when the quarterly results come out for companies that you're interested in.
And the other thing is that with our style of investing, where we look for the margin of safety before we buy in, we have to, for good quality companies, they don't stay at margin of safety prices for very long. So if you're seeing like the stock price fall out of the sky and potentially a time to invest, I mean, really, you have to follow the stock pretty closely so that you're in a position where you can make a quick decision if you need to. Like if the stock price is skyrocketing, do you want to sell? Or if it's dropping, do you want to buy? Or maybe if it's dropping, do you need to sell? Has something changed? So I find that if you've picked an individual stock and you're invested in it, I find that it does help to pay quite close attention to it so that you can, with confidence, you can make those quick decisions if you need to. But yeah.
Should I pose the next question to you?
Sure, do it.
So the next question we had here was, are index funds a wise first investment? What do you reckon?
I think probably and this is just my opinion, I think that for like 99% of people, they're probably a good first investment, because I mean, if it's a first investment, you probably don't know a huge amount about stock market investing. So you kind of, in a way, protected from your, if this is you, protected from your lack of understanding by wide diversification. But to be like a successful passive investor, it takes a long time. Like if you're in an index fund, you're not going to be a millionaire tomorrow kind of thing. So I think that while on paper it seems like a simpler way to invest, I think you just have to have the right temperament for it, because you have to be able to keep showing up every so often, and if you're following that dollar cost averaging approach, just to make sure that you keep investing and you even out to the market return over time. But like overall, I think that for me personally, when I started investing, index funds were a good way, or ETFs were a good way of kind of getting a feel for what the market was like without the risk of, losing a massive chunk of money in a very short period of time. So I think for most people, that'd probably be a good first investment. Yeah. What do you think?
Yeah, I agree with that. And I think the point you touched on about having the right temperament is really important. Because really how index funds are going to work for you over the long term, at least this is what the studies in the past have said, is that dollar cost averaging in theory tends to be the best practice, but it's not always how it works in practice for how people actually apply it. And the reason why is because people get scared of the market when it's going down, regardless of what they feel when it's going up. A lot of people sort of sit here now, and us included, I guess, think, well, I don't feel like I would have any problem buying stocks while it goes down. But things change when they actually are going down, and a lot of people struggle to continuously invest while the stock prices are going down and while their indexes are going down, and that's what's necessary in order to capture those averages. If you're only buying when the stock price is going up, then you're not going to capture anywhere near the average. You're going to capture something that's substantially less than that. But yeah, I agree that for most people, it's probably the simplest and most hands-off method for being involved in the market without having to deal with a financial advisor or a manager, I should say, an active manager, or having to actively invest yourself.
Yeah, I agree with that. I basically agree with everything you're saying there. All right, let's move on to this next one here. Do you have a spreadsheet of companies that are on your radar? And if not, how do you keep track of them?
That's a good question. I don't have a single spreadsheet. I don't sort of have a spreadsheet that shows all of the businesses in one single spreadsheet, but I do have my analysis spreadsheets, which is...
I was going to say, I feel a plug coming on.
Yeah, here it comes. I'm building up to it. No, but...
it's a good spreadsheet, though.
Yeah, I mean, this is actually what I do. I basically have a template spreadsheet that you can apply the numbers into for an individual business, calculates the growth, you can do valuation and all that stuff. And I just make one of those for each of the businesses that I'm analyzing. And as a result, then, if I see some news about a business on my watch list, I can quickly pull up that spreadsheet and see sort of what their growth has been in the past, and also what my valuation was at the time of the analysis. Yeah, if you're interested in getting it, I may as well plug it. I mean, we've already laughed about it.
It's very useful. In fact, I use your spreadsheet as well.
Oh, really?
It's very handy.
That's great. No, but yeah, if you want access to it, just head over to www.hamishhodder.com/spreadsheet. So very easy.
Nice. Yeah. And for me personally, like, I don't have a spreadsheet of stocks that I'm watching. Basically because I don't have that many stocks that I watch. Like, I can count the stocks that I watch with my hands alone. So, and like most of the stocks I'm on the sidelines for at the moment anyway. So I'm just kind of just reading and staying up to date, listening to conference calls and that sort of stuff. But yeah, for me, I don't actually have a spreadsheet that I try and monitor everything with.
Yeah, I mean, I'm pretty much the same as well, because I go through a lot of businesses I look at a lot of businesses, but in terms of companies that I would consider on my radar, meaning they're great businesses, but they're just not at the right price or something like that, there's really not that many. It's the same as you. I think there's probably less than 5 for me. There's very, very few. And as a result, it's not as if we have this huge spreadsheet that we're trying to, is stock number 74 on sale now? It's just a matter of, like, once a week I'll just go on Google, I'll just type in ticker symbol, check how the news is trended and what the stock price is doing. That's it.
Yeah, pretty much. All right, let's head on to this next question. Can you show us how to make a watch list of great businesses? Do you have any tips? How would you create your watch list if you were first starting out?
This is a bit of a follow-on from the last one, I guess, as well. But I mean, I guess this question, the way I read this question was more of how do we sort of start finding great businesses? How do I start shortlisting them?
That's the way I take it as well.
And really what I think is, as we said before, start by writing down your interests, your areas of expertise and your passions and things you might have skills in, all of the things in those areas, and just find out the industries where those overlap as much as possible. If there's an industry where not only is it a passion for you, but you're actually an expert in that industry, or you've worked in that industry for a particular period of time, then those are going to be the best places to start looking for businesses, because you already have a background of knowledge in those areas. And really what I do is I just Google search for a full list of every publicly traded company in those industries. So for example, if it's franchised restaurants, for example, you just Google search list of franchised restaurants on the US public exchange or something like that. And you'll be able to find an article or a page that has the complete list. And I just go through one by one manually, and I just eliminate them if they miss a requirement. And most of them are eliminated within about 10 seconds. So this isn't a huge process that takes years or something to go through 50 businesses. You can go through 50 businesses and narrow it down to 5 within probably half an hour, maybe even less. Because quickly. Most of the businesses, you just look at it, okay, too much debt, gone. Doesn't have increasing sales, gone. New on the stock exchange in the last 10 years, gone. Like anything like that, I just immediately eliminate it, and then you'll be left with a couple in each industry that deserve further analysis, and those can be the start of your watch list.
Yeah, I basically agree with what you said as well. The way I start, the way I think that people should start is you ask yourself basically a couple of questions. You ask yourself, where do you spend your time? Then you ask yourself, where do you spend your money? And then you ask yourself, what are you passionate about and what are you an expert in? You've got those 4 questions. If you can write down the answers to those questions in depth, then you'll see that across those 4 different questions, there are a couple of things that pop up in most of those answers. So that starts to kind of give you a hint as to what areas of business or what your circle of competence might turn out to be. And then as you're saying, from there, you just say, for instance, what am I passionate about? I'm passionate about, I don't know, sustainable energy and electric vehicles. I love cars and I love electric vehicles. Okay, sure. So then I could literally just go to Google and type in electric vehicle stocks, and it'll give you a whole long list. It'll give you NIO and Tesla and so on. And then from there, you can learn about that industry. You can, have a look at those individual businesses and see what's going on with them. And like you're saying, most of them you'll basically rule out straight away for one reason or another. So in reality, like while you might glance your eyes over a lot of businesses, maybe like literally hundreds of businesses. The actual amount of companies that you end up really exploring in depth, it's probably not very many, to be perfectly honest. It's probably not many at all. In fact, that's what I've found in my experience, is that really when it comes down to it, there are only very few companies that can consistently hit the key parts of their business that we look at, or the key numbers that we like to analyze. So yeah, I'd basically I've basically just said what you said again. I basically agree with everything that you ran through with that one. Yeah,
for sure. All right. And the next question we had here was, are there any good investing books that we've been reading lately? Ooh. Anything for you?
I don't know. I haven't read an investing book lately. I've just been so busy doing other stuff. But the most recent book that I read, I finally got round to reading One Up on Wall Street, which was first recommended to me by Sven back on that podcast that we did with him. And that was yonks ago. That was forever ago. But finally, and to be honest, I think it was soon after that podcast that I actually ordered the book. It's just been sitting on my bookshelf and I haven't read it. So I actually took the time to read it. And I really enjoyed it. I thought it was great. Have you read it?
No, I haven't.
No, it was good. It doesn't go into the valuation side of things, but it's very good at the psychology and how to classify different stocks and what to look for in each, like what's important to look for, like from say a balance sheet perspective, and it kind of gives you that understanding of what Peter Lynch, the process that he went through to find those great businesses that he did that ended up being like 10, 15, 20 baggers for him when he was managing the Fidelity Magellan Fund back in, when was that? Can't remember, like the 80s or something?
Yeah.
Can't remember. Yeah. But his record is unbelievable. What did he get? He got an average of 29% annually over 13 years.
That's crazy.
I mean,
pretty good.
with that return over that length of time, you can turn any amount of money into a lot of money.
Yeah, exactly. That's crazy.
Yeah. I'll look that up. Anyway, have you read any books lately?
Yeah, I mean, I'm the same. I haven't been doing a lot of reading recently. A lot less than I would have liked to. Just been very busy with other things. But
yeah, you get busy, don't you? Yeah.
We do, yeah. And I mean, the book that I've kind of been going through has been Security Analysis by Benjamin Graham, and I've been going through this book for a long time. And I'm not really, I mean, it's more of a textbook, so I'm not really reading it cover to cover. I'm kind of just picking out chapters and sort of trying to understand them a little bit further, and that's kind of been what I've been doing. But I haven't really read anything cover to cover very recently at all. Which something that I would like to do in the future a little bit more. Just had other priorities.
Yeah, I know. That's what I keep telling myself, man, I can't wait till things quieten down because I want to do this and I want to do that. In reality, it's not going to quieten down.
No. Yeah.
Maybe when we're 65. I think that's just like the type of people that we are, is that we're always doing something. Because especially when you run your own business, you just know that the more time you're going to sink into your business, the better it's going to be. So it's just like naturally you just keep working on it. Even when you want to switch off, you just keep working on it. It's probably unhealthy, to be honest, but that's the way it is.
Yeah, I mean, it's exciting because there's no end to what we could do. There's always another step, another level. Yeah. We could take it. Yeah. But the negative of that is that you never want to stop, and you never stop thinking about it. I don't know if I ever stop thinking about my online business. That's something that I kind of envy people who just have a 9 to 5. When they clock out of work, a lot of them can just forget about work. That's probably the only advantage I would think. I'd love to be able to switch off. My brain's at like 11 p.m. just running ideas.
Yeah, I'm the same. Hey, I looked up Peter Lynch. He got a 29.2% annual return during his 13-year tenure.
Wow, pretty good.
Damn it, I didn't look at when that was.
That's all right.
I'm finding it.
3, 2, 1.
Here we go. I found it. So it was in 1977, he was named the head of the Magellan Fund, which had $18 million in assets. By the time Lynch resigned as fund manager in 1990, the fund had grown to more than $14 billion in assets.
Jeez. Not bad at
Imagine
all.
turning 18 million into 14 billion. Whoa. That's crazy. Yeah, like what I said before. If you get 29.2% for 13 years, you can turn any amount of money into a lot of money. He's a good investor. Yeah, I don't know. I don't think I've read any other books. The one I reread Phil Towns' books not too long ago.
Right.
That was good. I just really like his writing style. I don't know. I just find those books very engaging. I mean, I'm not actually a big reader. All through when I was a kid, I really didn't like reading. Probably just because I didn't like the subject matter, but now I've found stuff that I'm interested in. I enjoy it much more, but I particularly like reading Phil Towns' books. What else have I read? I don't know. The Intelligent Investor. Gosh, that was dry. It's a good book, but man, it's dry. Dando Investor. I read that one a while ago, though. That's a great book, too. Monish Prabrai. Love that guy. Yeah, but, should we go on to the next question?
Yeah. Yeah, what are your thoughts on emerging markets?
Oh, gosh. To be honest, emerging markets, I just don't know. Like, I've never been to any Asian country before. I don't know anything about their markets. I don't know anything really about their culture and way of life, as unfortunate as it is. So for me, I put that firmly outside my circle of competence.
Yeah.
I mean, I can guarantee, especially with China being beaten over the last however long, there's going to be so many great opportunities in these emerging markets. It's going to be crazy. There'll be so many opportunities. But at the end of the day, it's just outside my circle of competence. So instead of trying to justify why I should buy this, this company, or maybe invest in this emerging markets ETF or something, at the end of the day, I just don't know enough about it.
Yeah.
What about you?
Yeah, I'm the same. I mean, there's nothing to say that there aren't opportunities in emerging markets. In fact, it's very likely there's probably more opportunities there. But we need to make sure that we're protecting our downside, and a big part of that is just we need to understand the businesses we're invested in, and not just the businesses and not just the industries, but the countries and the economies that they're operating in. And I mean, a big one for me is regulations. I don't know how regulations work in China or India. I know that the Chinese government has a lot more power to enforce regulations than, say, in Australia, where it has to go through a parliament and we have elected officials. That whole situation just makes me nervous because it's something that I'm not aware of sort of in theory, and I don't know how it works in practice either. That's another thing, is you can read about how the Chinese government operates and what they sort of do, but then to have lived there and experienced how it plays out in practice is another thing entirely. And those are kind of things that just make me feel nervous. And whenever I feel nervous about something like that, I just stay away.
You know what? I'm sensing we should do some sort of trip. I'm planning our overseas holiday already. Where would you like to go? We'll go to China, go to India, Taiwan.
Yeah.
Where else do we want to go?
China world tour. Let's do them all.
We'll have to. Well, I mean, there's only one way. I mean, as investors, we realize that the emerging markets are outside our circle of competence, so we better go and do some some hands-on research, first-hand research. I don't know. I'll start looking up flights. I'll get back to you. No, we got to. I want to do I want to do an America trip. That's the one that I'd be interested in.
Yeah,
go and meet all the other finance YouTubers. Go hang out, see what America's like. Have you been to America? I've never been to America.
I have. I've been a couple of times. So
yeah.
Well,
is it good?
It is good. Yeah, the weather's good in on the West Coast in California.
Yeah.
That's my favorite part about the US, is just the weather in LA. I need good.
It's nice and sunny.
I need warm weather always. Otherwise, I can't do anything.
Yeah, right. Oh, fair enough.
Yeah.
So we'll have to go. Oh, that's perfect. We'll come out of our summertime and we'll just head over there for their summertime.
Exactly. Perfect.
Perfect. Have we got a few more questions? I don't know.
Yeah, I think we had.
Going back to the document.
We had one more question, I believe. Maybe we'll finish up with this question because it'll probably take us a little while to go through it anyway. But this question was, what is the difference between Phil Town's 10 cap method and simply looking for a PE of less than 10?
I can kind of understand. I think, well, the main difference is that Phil Town's 10 cap method is just is looking for owner's earnings. And then from owner's earnings, if you want a 10% return, then you just pay 10 times owner's earnings. That's the 10 cap using the capitalization rate. But owner's earnings is not the same as earnings per share. So you work out your owner's earnings through the cash flow statement, whereas the earnings per share is an income statement item. So basically owner's earnings, I'd be interested to hear if we have kind of the same definition. Owner's earnings is kind of the first section of the cash flow statement, and then you subtract maintenance capex. So it's from my understanding, you start with your net income, and then you add back the non-cash expenses like your depreciation, your amortization, and whatnot. Then you adjust that figure for the changes in working capital, and those two steps is what the first section of the cash flow statement actually does. So in reality, I find that I just take the operating cash flow, which is the last line of that first section of the cash flow statement, and then from there you just subtract the maintenance capital expenditure. That's kind of what I find for owner's earnings, whereas earnings per share is an income statement number. It's it's net income. It's basically net income divided by the shares out. However, it also has to take into account was it preferred dividends? Is that right?
Right. Yeah. Remember. I think that's right. I mean, the way that I just think about it, aside from the formula, the way that you should think about what owner's earnings is it's the cash, so actual cash in and out of the business used to maintain the normal operations of the business. So how much cash is left over after the business has been just operated normally, and that's where the maintenance capex part comes in, maintain their assets, their physical assets, their machinery and buildings and that sort of thing. And I mean, the reason why that 10 cap is preferred, in my opinion at least, is, well, there's really two reasons. One is because EPS includes non-cash income and expenses such as depreciation, amortization, and that sort of thing. So it's much more likely to be, it's easier for a management to manipulate the earnings per share. It's very, very difficult, besides flat out fraud, for a manager to manipulate the cash flow statement, unless they're actually just going in there and changing the numbers on the income statement, which is just flat out fraud, basically.
Yeah, it's just illegal.
But it's much easier for them to push the earnings per share around based on devaluing intangible assets and that sort of thing. I prefer owners cash flow for owners, or owner's earnings, as I think Phil Town calls it. And the other reason was that I was just thinking of was that owner's earnings looks at the whole business cash flows. So you can kind of, it's a look at the whole business, which is kind of the view that Warren Buffett suggests when you're analyzing businesses, is to analyze it as if you're buying the whole thing.
Yeah. No, that's well explained. Yeah. Owner's earnings is about the cash flows. Yeah, cash flows of the business for the owners of the business, which as shareholders, that's us. Woo!
And I mean, if you're being just quick, like if you're just quickly looking at a business, then obviously glancing at the PE and seeing that it's approximately, 10 to 15 or something like that is a good sign. But when you're doing your proper analysis, I think, the 10 cap is one way of doing a quick valuation. And it's really just doing a quick version of the discounted cash flow, which is the full cash flow analysis that I would do. But both methods can be appropriate.
I think that's it.
That's it. Thanks, everyone, for joining us. Bye. I'm just kidding.
Yep.
Thanks, everyone, for joining us. And as always, if you have any questions or topics or anything like that for next week, then head over to the YouTube version of the podcast at youtube.com/Hamish Hodder and leave us a comment there. Topic, question, anything you got, any nice feedback for us is also...
Let us know if you have a topic that you want us to talk about, like middle section, like something that we can expand on further. Please let us know. Like, we want to make this podcast as helpful as possible for you guys. So if there's something that you just don't understand, or you'd like us to delve into a bit more, then just let us know and we can chuck it in the middle section.
Absolutely. And yeah, thanks as always for joining me, Brandon.
It's all right. It's all good. And love it. It's a good podcast on a Saturday morning.
Yeah, we can. Yeah,
it's always good fun.
So everyone,
see you guys next week.
Enjoy your day. See you later.
Woo! Bye.